What is the power of low correlation for portfolio diversification? Imagine trying to balance on a tightrope while the wind blows in different directions. That's what managing investments can feel like without proper diversification. When you build a portfolio, you want to avoid all your assets moving in the same direction at the same time. That's where the idea of low correlation comes into play. Low correlation means that the prices of different investments do not tend to move together. If one investment drops in value, another with low or negative correlation might stay steady or even go up. This helps smooth out the ups and downs in your overall portfolio. It's like having a team where not everyone gets knocked out at once. Correlation is measured on a scale from +1 to -1. +1 means two assets move exactly together. 0 means they have no relationship in their movements. -1 means they move exactly opposite each other. When you combine assets with low or negative correlation, you reduce the chance that all your investments will lose value at the same time. For example, stocks and bonds often don't move in perfect sync. When stocks fall, bonds might hold their value or even increase. Adding real estate investment trusts, foreign stocks, or commodities can also lower overall risk because they tend to react differently to economic changes. This broader mix helps protect your portfolio from sudden market swings. Mathematically, adding more low-correlated assets continues to cut down the overall volatility of your investments. This means you can aim for the same expected return but with less risk. It improves your chances of steady growth over time. For African American investors planning for retirement, this is especially important. It helps your savings withstand market downturns and economic uncertainties, making your retirement plan more resilient. Practical steps include mixing U.S. stocks with international stocks, real estate, and bonds. You might also consider alternative investments like precious metals or inflation-protected securities. Creating a sleeve of low-correlated assets within your portfolio allows you to balance growth with safety. In simple terms, the power of low correlation is that it reduces how much your portfolio's value swings up and down. It makes your investments more predictable and steady over the long run. For African American investors, this approach can help build wealth more reliably, especially during tough economic times. It's a smart way to protect your hard-earned money and keep your retirement goals on track.